Gold is going up. $10,000 is still a realistic estimate. I said some time ago it was 5. It got to 5. The price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze, 300 billion of their treasury securities, but Vera Nabiullina, who's the head of the Central Bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that. By the way, gold is having a nice bounce back. It's kind of rallying here. It kind of got smashed from about 5,400 down to 4,700 in a matter of a week or so. And that wasn't I hate gold. That was people sold gold because they needed cash. And this is symptomatic of this liquidity crisis. Stock markets, and to some extent bond markets, have not discounted what we're talking about. Now, the war will be over in 2 to 3 weeks. But they've been saying that for 9 weeks, Goldman Sachs and Morgan Stanley, and that money does come out of thin air, so that's true. What does the bank do with the money? The bank that just sold the Fed, the securities, what do they do with the money? So it's money supply times velocity equals nominal GDP broken into 2 parts, real and inflation adjustment.
Jim, last time we spoke, you had a potential outlook for gold at $10,000 by the end of the year. You said that that was feasible, and you broke down to us how that is feasible. In light of this conflict, where do you see gold ending this year?
$10,000 is still a realistic estimate. I said some time ago it was 5. It got to 5. That got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with the kind of inflation that we talked about, and the things we talked about earlier in the segment, Michelle. Central bank demand is not going away. Supply is flat. Central bank demand is going up. The safe haven asset attractiveness of it is going up. To the extent people do want to, I sort of poured cold water on the de-dollarization thesis, but the idea that central banks are moving from dollars to gold, that's true. That's very well documented. So that will continue to drive it. And then I did the very simple bit of math where I pointed out that if you use $1,000 increment as a marker, each $1,000 increment is easier than the one before because you're working off a higher base. So it's a smaller percentage gain. So
the quiet math behind this $10,000 gold call is more important than the headline itself. As Jim Rickards points out here, the real driver isn't speculation, it's structural demand, with central banks steadily accumulating while supply remains flat. That's a powerful imbalance markets tend to underestimate, especially when short-term pullbacks create the illusion of weakness. But here's what often goes unsaid. Higher base pricing compresses percentage moves, making late-stage rallies feel sudden and explosive to investors caught off guard. This isn't hype, it's compounding momentum. Next, Jim Rickards discusses why the path to $10,000 may accelerate faster than most expect.
So going from $4,000 to $5,000 an ounce is a 25% increase. That's a heavy lift. But going from 9,000 to 10,000 is only an 11% increase. That's much easier. So you kind of struggle. I don't know if it's the right word. You kind of struggle, or it'll take time to get to 6 or 7, but you're going to go 8, 9, 10 really quickly.
Okay, so that still is on target. And just to be clear here, you do not see this conflict as significantly altering the global monetary system.
I see problems in the global monetary system with or without the conflict. So I'm not sanguine about it. I think there's a lot of trouble in the global monetary system. The private credit meltdown, the central banks going to gold instead of dollars, a global dollar shortage because the banks are pulling in their horns. All of those are problems. The Iran war is kind of an overlay on that. So I think it makes it worse. I would say we have a global monetary problem anyway, but the war makes it worse because of the increase, not just the increase in the price of oil, but the supply. The U.S. is not going to run out of oil. We got plenty, but the rest of the world, South Korea, Japan, China, others, they're going to see supply shortages. They already are.
But in terms of impact of the dollar status as a global reserve currency, the impact of the war on that.
The dollar will remain the leading currency denomination. Again, it's the denomination that people
Like
don't
unit
have
of
$100.
exchange, yeah.
Well, the unit of exchange is not the reserve currency. People don't have stacks of dollars in the basement of the central banks. What they have are treasury securities. And no, I don't see that being reject it, but they are selling treasuries to get cash, which is a different issue. But gold is going up. I mean, the price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze, 300 billion of their treasury securities, but Vera Nabiullina, who's the head of the Central Bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that. And in fact, when the price of gold started going up from $2,000 to $5,000 an ounce, Russia made as much mark to market on the price of gold as they lost on the frozen treasury. So that was a pretty smart move by her.
And so wouldn't this conflict accelerate other countries saying, I'd rather have gold than dollars?
Yeah, I think that's absolutely right.
The real story isn't the war, it's the fragile system underneath it that was already cracking. As Jim Rickards points out here, the jump from $9,000 to $10,000 isn't the challenge. The real friction lies in breaking through the mid-range resistance where sentiment still doubts the move. But look deeper. A global dollar shortage, central banks shifting to gold, and forced treasury selling signal stress, not confidence. When countries sell assets just to access liquidity, that's not stability, it's strain. Investors should recognize this isn't a currency war yet, but a balance sheet crisis in motion. Next, Jim Rickards unravels how these pressures reshape global reserve strategy.
So a global recession is already baked in. What does that mean in terms of the US economy? What does that mean in terms of US equities? And what does that mean in terms of a potential response to that? Does that ultimately mean more Fed printing?
Well, we can get to the Fed, but in terms of the stock market, for example, the idea that the stock market is an efficient information machine and discounter of future news is nonsense. That's like AKA Eugene Fama. They all won Nobel Prizes for things that are nonsense. Stock markets are very inefficient. They run on emotion. They don't adjust gradually. They gap up, they gap down. There's volatility, etc. So right now, my view of the stock market is that stock markets, and to some extent bond markets, have not discounted what we're talking about. There's the narrative that Wall Street's on and what the stock market, the market is what it is. I mean, you can't really fight the market in that sense, but there's that based on a narrative. And then there's the reality. Reality always wins, but it can take time. So how many analysts on Wall Street have you heard saying, well, we think the war will be over in 2 to 3 weeks?
Markets are pricing optimism while the underlying data quietly points to contraction. As Jim Rickards points out here, the idea that markets efficiently price future risk breaks down during periods of emotional momentum and narrative-driven rallies. Right now, equities appear disconnected from recession signals, with volatility spikes and sharp gaps suggesting instability rather than confidence. The real concern for investors is timing. Markets often ignore reality until they can't, then adjust violently. This lag creates false security, especially for late entrants chasing strength. Understanding that delay is critical for protecting capital in uncertain cycles. Next, Jim Rickards discusses why market narratives are dangerously out of sync with economic reality.
The war will be over in 2 to 3 weeks, but they've been saying that for 9 weeks. I mean, that's my point. It's like, how many times do you say 2 to 3 weeks and the 3 weeks go by and you're still fighting when you're like, oh, you know what? Maybe this is going to last for years. Maybe this damage is going to take 6 months to a year to repair. Maybe when you start shutting down refineries, it's not like throwing a switch. You can't turn them on just because the oil shows up. The amount of what you have to do to get that, to prepare that kind of infrastructure to be used again after it's been shut down is enormous. And so that's already baked in the pie. Like I say, even if peace broke out tomorrow, which I don't expect, the damage has already been done, and the markets haven't reflected that yet.
Okay, so and in terms of a Fed reaction to a slowdown, I mean, does that not ultimately lead to more QE in any name, shape, or form, more money printing, more currency debasement, more devaluation? Ultimately, I guess a positive for gold.
Yeah, Fed money printing is so-called is kind of irrelevant. The Fed's mostly irrelevant to everything we're talking about. I'll kind of spend a minute on how the Fed creates money, and they do create money. You're right about that. So how does the Fed create money? How do they print money? Well, what they do is they have an open market trading desk in New York, and they call up the primary dealers, that's Goldman Sachs and Morgan Stanley and Citi and JP Morgan and all the big banks. And they say, you know, offer me 5-year notes. And the trading desk offers them 5-year notes. Done. The bank sends the 5-year notes to the Fed, and the Fed sends money to, you know, I'll say Goldman Sachs or Morgan Stanley. And that money does come out of thin air. So that's true. But then the question is, what does the bank do with the money? The bank that just sold the Fed the securities, what do they do with the money? They give it back to the Fed in the form of excess reserves. The Fed's a bank, and you can have an account there if you're a member of the Federal Reserve System, and they just give it back to them.
The timeline mismatch between market expectations and real-world damage is where risk quietly builds. As Jim Rickards points out here, repeated 2 to 3 week forecasts reveal how analysts underestimate structural disruptions like refinery shutdowns, which can take months, not weeks, to recover. That delay matters because markets often price quick resolution while the economic damage compounds beneath the surface. More importantly, the assumption that Fed printing will offset this ignores how liquidity actually circulates, or doesn't. When capital gets trapped in reserves instead of the real economy, stimulus loses effectiveness. Next, Jim Rickards shows why Fed actions may not deliver the impact investors expect.
That money doesn't go anywhere. It doesn't get lent. It doesn't get spent. It's not stimulating. It actually doesn't cause inflation. It just sits there. It's sterilized on the Fed's balance sheet. Okay. Where does the money come from that does do the things you're raising, that does cause inflation, that does, you know, help the economy or contract the economy? That money comes from the commercial banks. It comes from JP Morgan, and Citi, and, you know, Bank of America and Wells Fargo and all the rest. What are they doing? They can print money too, by the way. People don't understand that. If I go to a bank and take out a loan, and, you know, they put, okay, I sign a note that says, okay, Jim, here's your loan, and they put the money in my account, where's that money come from? It's ledger money. It comes from thin air. In other words, the banks can create money the same as the Fed. But in that case, I probably borrowed the money for a reason, and I'll probably go invest it or spend it or, you know, run a business, do something with it.
The biggest misconception in markets right now is where inflation actually comes from. As Jim Rickards points out here, Fed-created money often never reaches the real economy. It sits idle as excess reserves, creating a false perception of liquidity. What truly drives economic activity is commercial bank lending, and that's where the real leverage and risk exists. If credit creation slows, growth stalls regardless of central bank actions, something markets routinely overlook during easing cycles. Investors focusing only on Fed policy may be missing the deeper credit contraction unfolding beneath the surface. Next, Jim Rickards unravels why shrinking bank lending could outweigh any central bank intervention.
That's the money that counts. So what are the commercial banks doing in that vein? Well, they're doing the opposite of what you suggest. They're tightening credit. They're concerned. They're going to have write-downs from the private credit crisis. They're going to have customers to go bankrupt because of the higher price of oil. Or the higher price of oil is going to cause people to spend more money at the pump, which means they'll spend less money at the grocery store or you know, entertainment or vacations or clothes or new cars or whatever else it is. That part of the economy, again, where the money actually comes from, that's in retreat. So the Fed is mostly irrelevant. Fed money printing, it does exist, but it doesn't matter because it all stays on the balance sheet. You have to look at the commercial banks, and they're pulling in their horns.
So you're not seeing an expansion of monetary supply of M2 as a result of
No,
this
well,
conflict?
that's correct. Yeah, M2 is a very good measure, and no, not seeing an expansion of M2.
The real tightening isn't coming from the Fed. It's coming from banks quietly pulling back risk. As Jim Rickards points out here, commercial banks are restricting credit at the exact moment higher energy costs are squeezing consumers, creating a double hit to economic activity. When M2 stalls or contracts, it historically signals slowing growth or recession risk, something seen in past downturn cycles like 2008 and early 2020. This shift directly impacts spending, small business survival, and loan availability, far more than headline policy rates. Investors should watch lending standards, not just Fed statements, to gauge real conditions. Next, Jim Rickards discusses how this credit contraction feeds into broader economic slowdown risks.
We are seeing, we could see more of an expansion of M0, which is the Fed money. But as I say, it's irrelevant because it just ends up on their balance sheet. It doesn't go anywhere. Yeah, but you're right. Watch M1 and M2. That's the money that counts.
And M2 is typically what leads to inflation.
Well, okay, there's another element in the what's called the quantitative theory of money. Money supply is one of the variables, and real GDP is a part of the equation. Inflation or deflation, as the case may be, is part of the equation. But there's a fourth element that Milton Friedman overlooked. He just ignored it, which is velocity. So it's money supply times velocity equals nominal GDP broken into two parts, real and inflation adjustment. That's the quantitative theory of money. Irving Fisher, around 1920. It's a very good model to think about things, except Friedman and others assumed that velocity was constant. Velocity is not constant. So I can double the money supply, but if velocity drops by half, the nominal GDP is flat. In other words, money supply doesn't matter unless the thing you have to watch, the thing that would cause the kind of inflation you're talking about, would be an increase in velocity. But we don't see that.
And bringing it back to this conflict, do you see that? So you're not seeing inflation in terms of what people are paying for the price of goods as a real consequence of this war?
No, we're seeing a lot of inflation, but it's not because of money printing. It's because of supply. It's because of the supply shortages.
But I mean, as a future consequence, should
maybe
there be some kind of stimulus?
Not necessarily. There's nothing there's no stimulus in it. They say there's no cliche. I hate cliches, but some of them are good. The cure for high oil prices is high oil prices. In other words, right now, the price of oil is going up. We're going to see inflation. I'm not arguing that. But I'm saying, where's the inflation coming from? It's not coming from an increase in velocity. It's coming from supply shortages, closing the Persian Gulf, people desperate for oil, natural gas, bidding up the price, etc.
The inflation everyone fears isn't being driven by money printing. It's being driven by something harder to control. As Jim Rickards points out here, velocity is the missing variable, and without it, expanding money supply doesn't automatically translate into economic growth or inflation. What we're seeing instead is supply-side inflation, where constrained energy flows push prices higher, even as demand weakens, a dangerous mix for equities. This creates stagflation risk, where margins compress and consumer spending declines simultaneously. Investors relying on stimulus-driven rebounds may be misreading the cycle entirely. Next, Jim Rickards shows how supply shocks, not liquidity, are steering inflation dynamics.
Gas, I mean, I live, it's kind of not too high. In New Hampshire where I live, it's already $5 a gallon. I imagine it's $7 a gallon in California. That's going to flow through the transportation costs. Airline tickets are going up. The price of jet fuel is going up. So the inflation is coming. There's no question about that. But you have to ask why. Where is it coming from? It's not coming from money supply and velocity. It's coming from supply shortages. Now, how does that play out? Well, as I said, if I got to pay $5 a gallon for gas instead of $2.50, I can't not have the gas. I would say in general, American citizens, you got to pick up the kids at school or go to work or go to your job or do whatever you're doing. So the demand for gasoline is inelastic, but demand for everything else, luxury goods, even, clothing, movies, vacations, dinner out, all that stuff, that's the stuff you cut out because you're paying more at the pump. And that can take you to a recession.
This is how inflation quietly turns into recession, through everyday spending trade-offs. As Jim Rickards points out here, gasoline demand is inelastic, meaning consumers absorb higher prices there by cutting discretionary spending elsewhere. That shift hits sectors like retail, travel, and entertainment first, compressing earnings even if headline inflation looks manageable. It's a classic squeeze on real income, and historically these patterns have preceded downturns when energy spikes persist. Investors should watch consumer behavior, not just CPI data, to understand where the pressure is building. Next, Jim Rickards discusses how these spending shifts ripple through the broader economy.
We are seeing gold taking over as
Okay.
the leading reserve asset, and we are seeing treasuries being sold off in a pretty meaningful way even during this conflict. So yes, not dollars so much versus other currencies, but de-dollarization in terms of central banks not buying more US denominated assets and buying more gold.
Okay. It is true that central banks are buying more gold. You're absolutely right about that. And I think you framed it exactly right. The contest is the dollar and gold. It's not the dollar right now. The euro is about $1.16. You know what the euro was when it was launched in 2000? It was $1.16. In other words, 25 years later, the euro dollar exchange rate is exactly where it is. Now it's bounced around. It was up to $1.60. It was down to 80 cents. You know, it was like a great time to vacation in Europe. I understand that there's volatility. You can make or lose money trading. It's right where it was 25 years ago. There's no de-dollarization in the currency markets. Gold is different, and I agree with you completely. Um, the but what's going on with the dollar is not de-dollarization, except central banks are buying more gold.
The shift isn't happening where most investors are looking. It's happening quietly inside central bank balance sheets. As Jim Rickards points out here, currency markets show stability on the surface, with the euro roughly unchanged over 25 years, masking deeper structural changes underneath. The real signal is reserve allocation, where gold is gaining share while treasuries slowly lose dominance, not through panic selling, but through strategic rebalancing. This isn't a collapse of the dollar, but a gradual erosion of trust in paper assets. Investors ignoring this shift may miss the long-term trend entirely. Next, Jim Rickards discusses why gold's role is expanding even without visible currency turmoil.
When central banks are selling treasuries, which they are, there's the Treasury has a monthly report on international currency holdings. It's a spreadsheet and it shows all the countries and how much they own in treasuries. Countries are selling treasuries, but they're not dumping them to get out of them. They wish they had more. They're selling them because they need dollars. Again, a security is not a currency. It's denominated in a currency. A U.S. Treasury security is denominated in dollars, but it's not a dollar. If you need dollars, you got to sell the Treasury, get the dollars. What are they doing with the dollars? They're propping up their own currencies, and they're propping up their banks, and they're dealing with credit crises, whether it's real estate in China or a private credit in the United States. So there's actually a global dollar shortage and the beginnings of a global dollar liquidity crisis. And the reason people are selling treasuries is not because they hate treasuries. It's because they need the dollars to prop up their banking system and pay off bad debts. And by the way, gold is having a nice bounce back. It's kind of rallying here. You're right about that. But it kind of got smashed from around 5,400 down to 4,700 in a matter of a week or so. What was that all about? Again, that wasn't I hate gold. That was people sold gold because they needed cash. And this is symptomatic of this liquidity crisis. So we're not looking at de-dollarization versus other currencies. We are looking at increases in gold. You're absolutely right about that. But the bigger play is there's a global dollar shortage. We may be walking into a buzzsaw in terms of a global liquidity crisis. And by the way, Michelle, that has been happening for a while. That's been playing out for a couple of years. If there were no war in Iran and we were doing this interview, we'd be talking about that as a separate problem. The fact that you've got a dollar liquidity crisis, a private credit meltdown, and a war in Iran all at the same time is extremely concerning. And we could be looking at best, a recession and perhaps something much worse.
What looks like selling pressure is actually a desperate search for liquidity beneath the surface. As Jim Rickards points out here, countries aren't dumping treasuries out of distrust. They're liquidating assets because they need dollars immediately to stabilize their own systems. That distinction matters because it signals a global funding squeeze, not a shift in preference. Even gold sell-offs in this context aren't bearish. They're forced liquidations, a classic sign of tightening conditions seen in past crises like 2008. Investors should recognize this as stress building across multiple systems simultaneously. Next, Jim Rickards unravels how this dollar shortage could escalate into a broader financial crisis.
And do you see that happening? Do you see a global recession coming out of this, irrespective if we have a a deal, which does not seem like it's going to happen, or an
Right.
escalation?
Yes, and part of the reason it's happening now, and here's what I think a lot of people don't understand in terms of the Strait of Hormuz. Um, the Strait of Hormuz was closed almost the day the war began. I think it was February 22nd. I mean, check me on the exact day, but it was around the end of February. Um, but there was a lot of oil and natural gas and fertilizer, for that matter, in transit that was already outside the Straits of Hormuz. It was unaffected by the closure of the Strait of Hormuz. Now, that can take 2 or 3 weeks to get to South Korea and Japan and India and the ultimate users, and perhaps even longer, as I say in the case of South Korea. So the ships were underway; they were still delivering. The stockpiles were still there. There was nothing about closing the Straits of Hormuz that affected the supply immediately because it was already on the way. But now we're 7 weeks into this. Now the supply has dried up. There are no tankers underway. And it's really just now, as we speak, that the shortage is going to kick in.
The lag between disruption and impact is where markets make their biggest mistakes. As Jim Rickards points out here, supply chains don't break instantly. They unravel over weeks, which delays the visible economic consequences. The closure of a critical route like Hormuz doesn't hit immediately because inventories and shipments buffer the shock. But once those pipelines dry up, shortages emerge quickly. This delayed effect often leads markets to underestimate risk until it's already materializing. For investors, timing becomes critical. By the time data reflects the damage, pricing has already shifted.